Hi, I'm Pete Andresen with Andresen and Associates, and this is my quarterly review for the quarter that ended September 30th, 2022. It's going to include some statistics that happened after that, obviously, since I'm recording this in the middle of October. But I wanted to take the time to discuss a bit more deeply than I have in past shorter videos what's going on. So yeah, look, it's the light at the end of the tunnel. Now, 2022 has been very challenging. It could get more challenging. I don't know. As you'll see, we're already firmly into a bear market, although FOMO, fear of missing out, does pop up like it did today. I think the NASDAQ was up 3%. Look, one of the frustrating aspects of this is if you've been my client for more than a couple of years, you remember me obsessing about the fact that something was going to go wrong, and something did actually go wrong. Once the Fed stopped stimulating, it really is all about the Fed, isn't it? Anyway, we have still seen our portfolios lose money, even though I saw this coming because of the hit in the bond market. We have not lost, for the most part. There are a few clients who took a little more of a risk, but for the most part, we have not lost near what the indices have lost. However, the future is always opaque, and I have to stress that. And yet, we're already into the bargain zone. I think we might get more into the bargain zone, and I'll discuss what that looks like. But we are already seeing the seeds of a potential profound recovery, and we're seeing a lot of social change. If you remember back in 2020, I labeled this the big change, and I still think that that's what's happening out there. Keep in mind that everything that I'm discussing involves uncertainty and risk of loss, especially if we panic and sell out. We really don't want to do that right now. So, wow. What a year so far. As I've said, we'd be sitting pretty and looking marvelous if it wasn't for that big hurt in the bond market, because most of us didn't have enough of an allocation to equities to truly get dinged. But it's our bonds that got us. If you look at the blue line, that's the Vanguard Bond Index fund, and it's down over 15%. That's pretty dramatic. The NASDAQ is down over 30%, which is, the tech bubble is on the way down. And the stock market basically was down 25%, the big stock market. Now, just for fun, I threw the Oxier fund in there. We owned the Oxier fund, as you know. Can't say what the Oxier, legally, I can't say what the Oxier fund is going to do going forward. But back about 2020, I would hear from clients and they say, why are you holding this thing when it's not keeping up with the stock market? Well, right now, it's also very much not losing money like the stock market. So you see, diversification can pay off. What we're looking at, this is a rather important graph. This is October 13th, 2022. I don't understand the financial markets in the very short run. I very much understand them in the very long run, but this is inflation. And basically, in 4-decade highs for especially food. Food is the blue line, red is overall. So inflation is caused by consumer demand with too much money chasing too few goods. So guess what? All that stimulus in 2020, I mean, it was vast, historic. All that stimulus by the Federal Reserve and by the United States government did create inflation. But part of it is also due to just COVID, supply line disruptions. It takes a long time to change, but it does change. As you can see in this graph, look at the 2008 numbers. There was inflation, interest rates went up. Boy, did that change. We actually had some deflation there. So this is also regime change, I might add, that we're looking at, unless the Republicans figure out a way to burn that up. This is worth reviewing. Inflation I'm putting the almost in there to cover my butt, but the reality is that I've never seen inflation not do this. Inflation always features. So too much money and too few goods, rising costs of living, pent-up demand from something. Might be a war, might be a pandemic, could be both. The rising cost of living startles people and creates social unrest. There is political intervention. Sometimes it's good and sometimes it's not good. It usually is both. In other words, it's always like using a hammer to hit a mosquito. Rising interest rates come from either the pent-up demand for money or from the inflation, or usually from the central bank as well. So we've got those rising interest rates. That results in falling bond prices, and that creates financial market unhappiness. That usually results in the stock market declining as well as the bond market. We then have regime change. It really doesn't improve the situation, but we do have regime change. We usually have a recession right now. As of today, Bloomberg called for 100% odds. That's 100% odds that we're going to have a recession between now and this time next year. And the stock market soared because fear of missing out. Speculators feel that that means the Federal Reserve will stop raising interest rates and start stimulating. Right? Okay. I have no idea if that's what's going to happen, because the problem with government intervention is you can't look inside people's heads and you can't tell whether they had a nice meal last night. You can't tell what they're going to do. The pricing mechanism is a much better way of setting interest rates, but that's not what happens because government has to do something simply because that's what voters want. Anyway, you get regime change, you get recession, then you get a recovery. Recovery always follows. Then you get gluts, oversupply, deflation, and then the whole cycle repeats itself again. It might take 40 years, but it will repeat. The Depression of 1919 to 1921 is a great example of this. I am stuffing my brain with the statistics. I'll get into that later, but war, pandemic, it's all there. I mean, the 1918 flu pandemic, we had COVID, they had 1918 flu pandemic, really the two worst pandemics within the last couple of hundred years. We had inflation, social unrest, depression, that era of 1919 to 1921, it's all there just like us. And with no government intervention, it ended in 18 months. So a lot of times, government intervention actually makes things worse. I have no idea what government's going to do. And we cannot say that one political party or the other does a better job of it, because we've had examples of both parties messing this up big. Basically, less is better. If you want to read more, The Forgotten Depression, 1921, The Crash That Cured Itself by James Grant, I am doing it both print and Audible. I recommend Audible. It's actually quite a good listen. Okay, although it has happened many times historically, we aren't used to bond markets declining because it hasn't happened in about 40 years. And right now, the engine for that downturn is the rise in interest rates engineered by the Federal Reserve. If the Federal Reserve had not been involved, interest rates would have started rising several years ago, if not sooner. Credit quality is not an issue yet. And that's why the longer the maturity, the harder the hit. If you look at it, long government down there in the bottom, down 26.28. That's one of those safe treasury bonds getting its butt kicked with a negative 26.28% decline. We aren't even close to that. We were up in the, if you want to look at the short-term bond, and then some of our bonds got a little creative by extending the maturity because they wanted to up the yield. So we've had losses in the 10% zone, stuff like that. We have one bond, bond fund, Western Asset, and they're claiming that they're down 18%. They're claiming that there won't be a recession, that life's going to be good. They're upping their exposure to, shall we say, high yield bonds. That's the word I'm searching for. But anyway, they're down 18%, and I'm not getting out of them because we're very diversified. And if we're right, they will figure it out. They've got a great history of knowing what to do. But also, if we're wrong and we don't have a recession, that's a good backstop. So you see, bond intelligent minds are all over the place and everybody's guessing. But that rising interest rate has really unsettled the bond market. And that's where you and I, have taken the unexpected hit in our portfolios. And so, because of that unexpected hit, very unusually, diversification hasn't been very effective because almost everything has gone down. Almost everything, except for petroleum. That makes this year about the third worst year for the 60% stock, 40% bond portfolio since 1926. This is from an article by Jason Zweig. I'll post the link in the comments of this video. Basically, you can see 2022, I've been reading too much about that last depression. It's a pretty bad hit for a 60% stock, 40% bond portfolio, and we're not even close to that. So actually, we're successful. We're doing better than a 60% stock, 40% bond portfolio. At least most of us are. It's very rare to see this kind of damage. So yeah, if it feels like an ugly time, it is an ugly time. Of course, bonds tend to heal themselves if you don't get too excited because you just hold them till maturity, and we're mostly in short-term bonds. So that's actually a doable deal. I am actually quite positive at this point because we're already into a place where, historically anyway, this is a graph from a Wealth of Common Sense. That's a blog. I'll post the link in the comments. If we have courage, history suggests that good things may happen. If you look, since 1950, every time the S&P 500 is down 25% or worse and we buy, 1 year from now, we're good. 2007 is what we're trying to avoid. Also, we're trying to avoid the 2000. If you look at 2000, 10 years later, you had an increase after buying 25% down, you got 38% back in 10 years. That sucks. So we're trying to wait to see if we can get a little more of a decline. Also, look at 2007. 10 years later, you're up 209%. I'm into that. But with a recession on the horizon, I have been slow to stuff my face. We don't know what's really going to happen. But history's on our side at this point. This is big. We really have to be paying attention here. The dollar is rocking. It's higher than it's been in some cases in 40 years, depends on the currency. When this happens, it suggests strongly that the big power is going to be in international investing. We can't walk through this. I am absolutely aware that tech and the S&P 500 have outperformed international investing very much in the past 10 years, but they didn't do it in the first 10 years of the 20th century, 21st century. International paid off. So when do we get in? I'm waiting again for those bargains. Now, Britain has been torn asunder with the first financial panic of this downturn. I expect there'll be more financial panics if this continues. They're actually having to reprice their pension plans. I expect that will happen here as well if this continues. Meanwhile, the brown line is about where the S&P 500 is. I think that doesn't warrant an intervention at this time. The blue line is small stocks in the British stock markets. That's attractive to me, but I would rather let the recession start to happen first because of that FOMO, fear of missing out. I am watching too many investors dive in when they think it's all about the Federal Reserve. Of course, they're right in the long run. But if the Federal Reserve does not go their way, we're looking at another 10 or 20% down from here. I don't want to be taking your money in if that's what's going to happen. So here's the bottom line here. I expect more turbulence and probably, but not certainly, a global recession 2022 to 2024. Yes, it could take until 2024 before we really see gains. So the plan for the rest of this year, which is only 2.5 months, and then you could say the plan extending into 2023, is that I'm going to continue to take tax losses where appropriate. You've seen me do that already. I'm going to mildly extend the maturities in the bonds. That's reach out a little bit because of a potential recession, and I'll get into that. Increase the credit quality in bond funds. And the reason is that if we have a recession, credit quality is going to become an issue. That's the second shoe that's going to drop in the bond market. In other words, high yield bonds will come under pressure like the stocks, but interest rates should cap out and probably decline a little bit. So I'm going to be mildly extending those maturities. This is why I've held a Western asset. And besides, they could be right. I'm going to maintain optimal mutual funds and fund managers in our portfolio if possible. I call that weeding the garden. In other words, if we've got a fund that's just blowing a hole in the pavement, and there aren't very many of them, in fact, I can't remember one so far, I will weed that fund out and try to get mutual funds that really have good long-term track records. I'm going to gradually grow our international holdings, although gradual is the key word, because I am looking for that recession and a depression, or depression in Europe is quite possible, or recession is going to drive those values down a little bit. If declines resume, I'm going to buy gently. If declines really climbed all over us in the next couple of months, I would be buying aggressively, but I'm not seeing that. I'm going to be prepared for the unexpected. Most particularly, I am being prepared. I'm being prepared. I am preparing for Europe. It's going to be a tough winter, and Ukraine war could spin in a direction we hadn't really planned on. Also, China is a wild card at this point, not only politically, but economically. And there are, of course, all kinds of different things that could happen. So we have to be prepared for that and not jump too profoundly at this point. I'm going to try really hard, and I commend this to you. Stay sane, stay healthy, enjoy life, and don't let the crazies out there, because now is the media time for them to shriek in hysteria. And every day a client will send me a YouTube video from somebody who predicts that asteroids will hit the Earth. Hasn't happened so far. This thing is not worse than the 1919 to 2021 downturn. So history has told us that we have seen worse than, by far, than this. So stay sane, stay healthy, enjoy life, enjoy the holidays. The best of life does continue in the worst of times. This is opportunity to me. This is my chance to add value. I am doubling down on managing your portfolios to attain long-term success. Change is unavoidable. It's engulfing us. The big change, it's happening. And yet we tend to approach it with fear, anger, blame, and guilt. I should have done this, I should have done that. That you can't do that, because the very nature of change, the very nature of time, is that you cannot see the future. The reality is that change is painful. Change is frightening. And it often brings big opportunity. And I think that big opportunity is here with us now. Fighting our own minds is part of that success. History is telling us that one of the great bargain times of history may lie ahead, and it may already be here. So once again, patience, time, discipline, and consistency. And blessings. Please enjoy the holidays.